So in the previous video, we just discussed about the different monetary policy instruments and we said repo rate, reverse repo rate and all were a few of the instruments. In this video, we are going to cover repo rate, reverse repo rate, liquidity adjustment facility and marginal standing facility. So let's begin with repo rate. What is repo rate and how do we define it? Repo rate is the fixed interest rate at which the RBI provides overnight liquidity to banks against the collateral of government and other approved securities. I repeat, the fixed interest rate at which the RBI provides overnight liquidity to banks against the collateral of government and other approved securities. Okay, now let's break down this definition. Okay, let's break down this definition. What are the components of this definition? We say repo rate is a fixed interest rate. Okay, repo rate is a fixed interest rate. Who fixes this interest rate? It is fixed by the RBI. So it is not a floating or dynamic rate. It is a fixed interest rate. Now, the RBI provides overnight liquidity to banks. What does this mean? It means if banks have a shortage of funds, then RBI is lending money to the banks overnight. Okay, so RBI is lending money to the banks overnight. That is the fixed interest rate at which the RBI is providing overnight liquidity to the banks. Is the RBI providing overnight liquidity to the banks simply like that? No, it is asking for some kind of collateral, right? It is asking for some kind of collateral. What is the nature of the collateral that the banks have to give to the RBI to avail overnight liquidity? The nature of collateral is government and other approved securities. It can be government bonds or other government approved securities. So the banks have to give government or other approved securities to the RBI, and on the basis of these government and other approved securities, the RBI will extend a loan overnight to these banks. So I'll repeat the whole definition now because we have understood each of the components, right? So the fixed interest rate at which the RBI provides overnight liquidity to the banks against the collateral of government and other approved securities is known as repo rate. Okay, so this is the definition of repo rate. I hope this is clear. Now we'll move on to reverse repo rate. Now, just do the opposite of what we did for repo rate. I'll I'll tell the definition of reverse repo rate now. Reverse repo rate is the fixed interest rate at which the RBI absorbs liquidity from the banks on an overnight basis against the collateral of eligible government securities. Okay, so reverse repo rate means if the banks have more money than they need, then they can park their money overnight in the RBI. Once they park their money overnight in the RBI, they'll get some interest on this money, right? So the fixed interest rate at which the RBI absorbs liquidity from the banks on an overnight basis is known as reverse repo rate. Quite simple, right? Okay. Next, let's look at liquidity adjustment facility. Liquidity adjustment facility is also known as LAF. LAF is LAF. Now, the liquidity adjustment facility consists of overnight as well as term repo auctions. Okay, this is what you have to understand. Now, when we are talking about repo and reverse repo, we're majorly talking about overnight liquidity that the RBI is giving to the banks. Or overnight, the banks are going to park their excess money with the RBI. This is what we spoke when we were talking about repos. But when we talk about liquidity adjustment facility, it consists of overnight as well as term repo auctions. Okay, now let's say banks need to borrow for 7 days, then they can go for liquidity adjustment facility. Let's say the bank want to take a loan from the RBI for 14 days, then they can go for liquidity adjustment facility. If they just want it for overnight, then they can use repos. Okay, now repos are available overnight, 7-day, 14-day maturity periods. Let's be very clear about that. Okay, now the liquidity adjustment facility began to be operated through overnight fixed rate repo and reverse repo from November 2004. So this is about liquidity adjustment facility where we can use term repo auctions as well to control the money supply in the economy. Okay, now let's look at the next definition, which is marginal standing facility. Now, what is marginal standing facility? Standing facility is a facility under which scheduled commercial banks can borrow additional amount of overnight money from the RBI by dipping into their statutory liquidity ratio portfolio up to a limit at a penal rate of interest. Up to a limit at a penal rate of interest. This is what we say. Now, let's break this definition down so that we understand its individual components. Now, in marginal standing facility, scheduled commercial banks are borrowing money from the RBI on an overnight basis. Okay, this is very clear. Marginal standing facility means commercial banks are borrowing money from the RBI on an overnight basis. Now, when we have repos, we said that the banks have to provide some kind of a collateral, and this collateral could be in the form of government approved bonds and securities. Right, this is what we said. So, on the basis of them pledging their government approved bonds and securities, RBI will give some kind of an overnight liquidity to the commercial banks at a fixed rate of interest known as repo rate. Now, let's say they have taken they have pledged, let's say bank A has pledged all its government securities and it has taken overnight liquidity from RBI. But this is still not enough for bank A. They need more money. Then what will they do? Then they'll say, okay, now we will dip into our statutory liquidity ratio portfolio and then we will take more loan from the RBI. But the RBI does not like it that the banks are doing like this. So what they will do, they will have a penal rate of interest. Generally, what happens is banks can borrow from the RBI at the repo rate. Now, let's say repo rate is at 5%. When the banks are borrowing from the RBI under the marginal standing facility, then they are dipping into their SLR. So they have a penal rate of interest. This penal rate of interest can be at 5.5%. Right? If repo rate is at 5%, MSF can be at 5.5 or 6%. Okay. So that is the penal rate of interest. Now let's look at the definition again. When we look at the definition, we say marginal standing facility is a facility where commercial banks can borrow from the RBI for overnight liquidity by dipping into their statutory liquidity ratio portfolio up to a limit at a penal rate of interest. I hope this is clear. Now, why is the MSF necessary? The marginal standing facility is necessary because it provides a safety valve against unanticipated liquidity shocks to the banking system. Okay. Now, the simplest way to look at it is, let's say bank A is suffering from a liquidity crisis and it is not able to maintain its liquidity overnight and it needs some kind of help from the RBI just for, let's say, a very short term. In this case, what happens is this bank A will go and give all the government securities and collaterals that it has and it will borrow at repo rate from the RBI. Now, even after borrowing from the RBI at the repo rate, if the total funds that is necessary for bank A is not sufficient, then what bank A will do is it will dip into its statutory liquidity ratio portfolio that is kept with the RBI and it will borrow more funds from the RBI to meet its overnight liquidity necessities. So, when the bank A is borrowing from RBI by dipping into its statutory liquidity ratio portfolio, then the RBI says, okay, you are not doing the right thing, so I am going to fine you. This fine is the penal rate of interest. That is that extra 50 basis points or 100 basis points on top of the repo rate that is charged by the RBI. Okay. So this is known as marginal standing facility rate. So why does MSF exist? MSF exists because if there is an unanticipated liquidity shock to some banks in the banking system, then they should not be left high and dry because RBI is the lender of the last resort. If the RBI is not lending to the banks, who is going to lend? Nobody else is there. It is the RBI who is the lender of last resort to these banks. So as the lender of last resort, marginal standing facility is one of the facilities that is a safety valve against unanticipated liquidity shocks to the banking system. This concludes this video. We'll continue looking at these tools in the next video as well. Thank you.